I've tried day trading in the past and lost quite a bit of money, but for a short period of time I was able to make some consistent profits. So let's see if it's really possible to find a day trading strategy, put it into practice, and actually make some money with it.
Step 1. Find an edge.
The edge comes from seeing something happen over and over in the market with some level of predictability, aka a pattern. There are quite a few to pick from, but as a complete new beginner, I wouldn't even know where to start looking for one, so I did have to take some courses from some social media trading gurus, and I'm going to be using one of their most popular strategies, the bounce short. I'll explain what it is, but going forward, I'm going to be throwing around some day trader lingo like float, volatility, pre-market, resistance. If you don't know what these things mean, you can always look them up on a website called Investopedia, then come back to this video. As a complete beginner, it may be a little frustrating because it's a lot of new terms just being thrown at you. I get it, but it'd be like that sometimes. So now, something all these courses mentioned is this bounce short strategy only works for small cap stocks, which have their own unique way of trading, because most of these stocks, statistically speaking, are likely to fail in the long run. You're not going to trade Amazon the same way you do DFG Therapeutics, which is a shack with like 2 employees. So keeping that in mind, the most probable, repeatable way to make money here is not to buy, but to short, profit on the way down. Hence why it's a shorting strategy. That makes sense to me. So this is how it goes. Whenever one of these sketchy small cap companies needs to raise money because they're not profitable and can't pay their employees, they usually come out with a news article made to attract unwise new investors. It's worded in a way where at first glance it appears revolutionary. DFG Therapeutics submits FDA application for a phase 1 trial of cancer curing research. Sounds amazing, right? It's not. In reality, it doesn't mean anything. It's just made to lure people in. They do this with the help of some other sus financial companies called underwriters. The underwriters pump up the price of the stock once the news article is released enough to attract retail investor attention. People see this artificial rise up in price along with the amazing news, thinking it's other people buying in, which gives them FOMO. So they buy in too. And that's when they dilute their shares, leaving the retail everyday Joe investor stuck holding the bag. I think there may be a term for this sort of phenomenon. I may have seen it somewhere before. This is the legal way of doing it. Anyways, time passes and Joe is stuck holding on to his loss for months, maybe even over a year, until the next time the company runs out of money and has to do the same exact thing. When the price pumps up this time, Joe is not going to be in the mood to play any more games. He's likely going to sell his shares at break even or a tiny profit. This selling, along with them just diluting their shares again, creates selling pressure or resistance, which drives the price down. And that's where I hypothetically enter on the short side to ride the price all the way back down. That's the bounce short. That's how it is in theory, at least. It's always easier in theory.
Step 2. Refine your edge.
Okay, so just looking at a pattern and having a basic understanding is not enough to actually start trading. There are a lot of specifics I need to find now. What is the ideal float range of the stocks that this works for? Which price level are the bag holders trapped at? What if the time difference between the first and the second pump is only 1 day? What about 2 days? Do the odds increase or decrease? Take a coin now or
double it and give it to the next person.
But there are a lot of questions that need to be answered, and the only way to answer them is by gathering statistics of past bounce shorts and letting the data give us those answers. So how am I going to do that? There are 2 free ways that I know of. The first one is by going on one of the YouTube channels which live streams trade idea scanners. I'll skim through the past streams and see which stocks are going up and gaining volume. Then I'll take those stocks and look them up in my trading platform. If they're bounce shorts, then I track their information. If they're not, then I just move on. The second way is by using a website called Statistical. They have a free version, so you don't have to pay for anything. Here you can set up parameters and they'll give you a list of stocks which fit those parameters. I personally prefer this way because it's just a much more precise way of getting results. Less junk I have to sift through, and it just makes the whole process faster. I'm not sponsored by them or anything, that's just what I use. I'm on it right now. My criteria here is any stock that has gone up 40% or more from the previous day at some point, with an opening price of at least $1 and a total daily volume of at least 1 million shares traded. So I ran that through, let Spaki do its thing, and started going through the data. Okay, it's been about 5 hours since I started. This is a long process, but to give you an in on what's happening, I look up all the stocks that Spiky gave me on my charting platform. If it fits a pattern, that's when I bring it over to an Excel sheet and track all the factors which I think will matter for it. Once I have enough samples, then I'll crunch all the numbers to see which factors give me a higher winning percentage, a lower winning percentage, and which ones just don't matter. But first, I'm hungry. Let's grab something to eat.
Combination jab, slip, uppercut, backhand, roll. This is you, bouncing. All wasted movement. Jab, slip, uppercut, right hand, roll, and then what? Then we're still here, boom.
Okay, after about 9 hours of work, welcome to my statistics. At first, I wanted to check if it's even profitable, so I did some calculations, and with an account of $5,000, I'd be making 2.1k in profit after 20 trades, which takes about 6 months, turning the initial 5k to 7.1k, so in theory, it's profitable. This is only if risking 10% and aiming to make 10 to 15%, giving us a risk to reward of 1 to 1 or 1 to 1.5. The winning percentage was 66%, so we win more often than we lose, and when we do win, we make our losses back, and in some cases even more. Okay, these next parts are gonna get a bit technical, not gonna lie to you, but the minute nuances I'm gonna talk about are needed to make the strategy work, so just stay with me here. I tried making the stop losses tighter because I've always heard it's a good idea to cut the losers quick and let the winners run, but in this case, that didn't work out at all. It wasn't even profitable this way actually. This strategy needs some breathing room, but something I had to keep in mind when calculating these statistics is in order to be able to short, I have to pay shorting fees to my broker. Win, lose, or draw, they want their cut.
Ooh, I like your cut, G.
So realistically, with these fees, when I'd win anywhere from 8 to 13%, and when I'd lose, it'd be a constant 12%. That's unfortunately one of the drawbacks of shorting. The fees are quite high, but I did keep this in mind when calculating that 2.1k profit. Now, there are some more very important nuances here. First of all, none of my statistics were gathered before February of 2022, because during that time, it was years of flourishing, beautiful bull markets, and after February, things changed. So the strategies that worked then either just don't work at all anymore, or they work differently. I learned this one the hard way. Now, for the next major key, sometimes in the initial spiking day, the volume would be really spread out all over the place, so I would have no idea of knowing where the resistance and the bag holders are, since people made transactions everywhere. For cases like these, I'd look to see if there's a confirmation of resistance in the next upcoming days or months. So if the price goes up to those levels again and then stuffs down at a certain point, that tells me the place where it stuffs down is the actual resistance. If that doesn't happen though, then I just use the uppermost point of the initial spiking day as the resistance, because I know if it breaks past that, then my pattern is invalidated for sure. And if it spikes but doesn't reach anywhere near those levels, then I just miss it. Another detail is the day we enter short, the stock cannot have higher volume than the initial spiking day. Think of the volume as fuel. If there's significantly more, there's also a higher likelihood that the stock can break past whatever selling pressure. And the last one I'm going to mention is the stock cannot be parabolic when entering, meaning a really fast aggressive move to the upside. Because even though these do work, they also move extremely uncontrollably quick. So I could enter and the next second have my whole account blown up because I couldn't even set a stop loss fast enough. So when I see this type of action, I steer clear.
I don't touch this stuff, not gonna touch this stuff.
First day I got the stock LUCY, the volume was pretty spread out, but luckily I got a confirmation of resistance during pre-market at the $4 price level. As soon as it got close, I entered for a short position at 368 with a stop loss at $4.05. It ended up respecting the $4 resistance perfectly and dumped down 15%, giving me a $750 win. At this point, I was feeling pretty nice, not gonna lie. Right after that, I got another chance on the same day on ticker GSUN. The initial spiking day also had really wide resistance, but there was no confirmation this time. So because of that, I had to use the highest point as the resistance, which was 3.3. I entered at 308, which puts my stop loss at 338, 8 cents higher just in case some funny business happens. And it was looking good, respected the resistance perfectly, until funny business happened.
Stupid, I'm not gonna let you get the chance.
I am having a very bad day. I am in no mood.
Today is one of the worst days.
That literally wicked me out on the cent and then went my way. Feels almost personal. Watch it hit my take profit now too, without me in it. Yep, can confirm it did exactly that. This is what is known as a stop loss hunt. Quite annoying, but with that at the end of day one, I'm at $250 profit. A little bit less once you take the fees into account. On day two, there was some potential, but nothing really met the criteria, so I didn't trade anything. On day three, there was ticker ICU, which had confirmed the resistance on a previous day at 6.3. I entered short at 5.8 and it ended up going down really smoothly, giving me a 15% win, which equates to $783 this time, putting the 5K account to $6,000. Okay. Looking at this realistically, the wins going forward are probably going to get smaller and some losses are due soon too, but as of right now, 3 days in, it's looking amazing, $1,000 in profit. I waited for a few more days, but since the strategy doesn't appear that often, I didn't get any more chances to play it. So, is this short-term performance repeatable in the long run? Probably not to this extent, but to a degree, I think so. Hope you enjoyed the video. Peace.